We mentioned Mr. Grasso because he is joining the closing bell exchange today, as are Kourtney Gibson from Loop Capital and our own Rick Santelli, as always, at the CME. Steve, we'll come to Turkey in a moment.
Right.
Let's come back to the U.S. first of all.
I concur with Sarah. It is stabilizing.
It is.
And they have a long runway.
You have to tell your kids something.
That's right. That's right.
And they've announced some interesting measures actually today, which we will come to. But back to the U.S. markets,
Right.
New highs. What should people be doing?
So usually you're better off buying new highs, not selling new highs. And if you go back to the January effect where those new highs were sold and the market traded off by 11% to that February low, that was a different state of affairs that we're having now. We're going into year end. Catch-up trade. Funds are trying to make up their performance. Whatever they had or didn't have, they're trying to chase it into year end. They're chasing materials, they're chasing staples, they're chasing their underweight names, but I would say stay in technology. That's the growth that you want to chase.
Why? Because of earnings?
Because of earnings. Where else are you getting 20, 25% growth, pretty stable in an environment where for the last 5 years, technology has outperformed every other space by 2 to 1 and sometimes even more than that.
Kourtney, do you agree with that call? It's also facing some at least regulatory noise into the midterms when you look at stocks like Facebook and Google and Amazon. Do you still buy technology as a leader in this market?
Oh, absolutely. I mean, technology is what's driving our world right now. Not having tech in your portfolio only will hurt you in the long run. I mean, even if you look at what's driving the Dow today, and we don't typically associate the Dow with tech, but if you look at Microsoft and Apple are the second and third leaders in the Dow right now and what's driving it. So even though you're seeing a little weakness in the NASDAQ, the components of the Dow related to tech are what's helping to drive this rally that we're seeing right now.
Rick, are you surprised by the size of the dollar move today to the downside? I guess it is a risk-on day and therefore the safe haven dollar giving up a bit of ground, but it's a surprisingly big move. What's driving it?
Yeah, no, I'm right with you there. I really think that the logistics of the dollar trade and the price positioning of some of the long positions that were added over the last couple of months is one of the big factors. I don't see a huge big move in the dollar much lower. I think 92 and change. We're just right below 94 right now. And it isn't surprising either, especially after the central banks of Europe and Japan have already rendered their decisions. We know Norway raised, the Swiss didn't. Really no surprise on Swiss. But next week with our Fed coming on board, I would suspect that the dollar index as we get into Monday, Tuesday probably finds a bit of a floor. I am just enamored, though, as a technician, Wolf, to tell you that when you have a January where stocks and interest rates did what they did almost straight up, and then for the next 6 months virtually gave it up and moved sideways, to regain that ground when you look at it as a technician is a very optimistic issue for the pattern continuing, in this case, to the upside, not only on stocks but rates as well.
Do you agree with that call? And then the fundamentals behind the move as well. You know, you had all sorts of uncertainty on trade. Things have only escalated since then, but the market has appeared to shrug it off.
So now I would say that there's been a de-escalation in the trade talks where
Between
everyone...
who? Not U.S. and China?
You don't think there's been a de-escalation?
No, we just put on new tariffs on $200 billion.
But it was supposed to be 25%. Now we inched back to 10%.
If they don't come by the end of the year.
And then the retaliatory trade tariffs were supposed to be between 10, 20, and 25 from China. Now they're going to be between 5 and 10. So I would say that that's a win for the market. If the market is priced in more, you have to go with that being...
tariffs, though, growth killing?
To a certain extent, but how long and how many years has this been just such an unbalanced trade? And both sides of the aisle have complained about it for 20 years now with China.